Welcome to our clients and friends around the country and around the world on our latest Zoomcast. This particular one will dive into financial independence and what are some of the threats, opportunities. We've had a number of client questions around this area, so we're going to tackle those today. Joining us are Tara Maxwell, CFP, who is our financial planning manager, and Glenn Joyce, CFP CFA, who is our co-chief investment officer. And so let's jump right in.
Good morning, and thank you for that introduction, Dennis. I first want to start off by setting the stage of doing a few reminders of what your financial plan is if you go through the planning process at Stearns Financial Group. So when we create your financial plan, just as a reminder, it's very unique to you, and it incorporates all of your financial factors and your goals and your desires and really what you want out of life. It also is a tool that, just as a reminder, we are using to give us a big picture. So we're going to be focused on looking more at the glide path that's provided once we do your financial plan, because we know that things in life change from time to time. And so we're never going to get down to the exact dollar correct, but we're really focused on the big picture. What does that glide path really look like? And how does that glide path change under various scenarios? The other reminder about your financial plan is that we always need to make adjustments along the way. And sometimes those adjustments are because things in your control that are positive, or sometimes they're negative. But we just need to remember that this is a map and that we don't do it once, but we have to go back and continue to revisit it. And so while your financial plan is very unique to you, we're going to use two couples today to help us explain some of the 5 big questions that you guys have been asking us. So we're going to look at 2 couples today, and I want to help you visualize these 2 couples. So you don't need to remember every detail that I tell you, but just think about them in general. Put yourself in their shoes. So our first couple is the working couple. And what we see with our working couple is, in this example, they are both 55 years old. They are both earning $150,000 annually. They're both saving into their 401k, and they both hope to retire in just 10 years at age 65. When they retire, they plan to take their Social Security, and they don't want to have any debt. So currently they have about $1.1 million in assets, and they also have a nice home that is debt-free. They plan to spend $120,000 annually. So that's our working couple. Our second couple that we're going to explore to help answer these questions is our retired couple. And this is a very similar couple, except it's 10 years later. So this couple is age 65, and they both just retired. This is their first year of retirement, and they both just began receiving their Social Security. They have assets of around 1.6 million because they've done that extra 10 years of savings. They also have no debt on their home, and they again are going to spend about $120,000 annually. For both of these couples, just to give us a baseline, what we're going to assume is for their investment accounts that over the next 5 years, they earned a 5% return, and thereafter they earned a 7% return. And the reason we're using this for our baseline is pre-pandemic, we were thinking that the valuations were at such a level that we might experience lower returns in the near future before we go back to a more historical return. So that's going to set the stage for our 2 couples that we're going to look at today.
So one of the questions that we get quite a bit is, okay, investment returns are lower in 2020 and maybe longer depending on how fast we get back to pre-pandemic levels, but spending is also lower for many people, and people aren't taking as many trips or doing other things. Now again, generalities, we have a few clients who are spending close to what they were pre-COVID, and we have a few that are literally almost half. So every person's unique circumstances have to fit into all this. And so the question we often get is, well, which one of those is more important to longer term financial independence? So let's go to the next slide.
And Dennis, that's a great question. And before we go back to our couples to help us evaluate how this would impact their plan, we first want to show you a chart that talks about the savings rates in the pandemic. So here, if you will focus on the blue line at the very tail end, you can see how savings rates have just skyrocketed now that we're in that pandemic. And as Dennis just mentioned, that is true of some of our clients, and some of our clients are not saving at that level because they're finding other things to spend their dollars on. On the next slide, we're also going to show one other concept that lots of clients are talking and asking about. And so what this slide is showing is on our green line that ends up at the bottom of this chart that doesn't have the squares. What it represents is a retired couple at age 65. And this couple takes out a set amount in the first year of retirement. And on the bottom line, what they're doing is they're increasing the amount that they take out every year by inflation. And so what they're doing is they're not paying attention to market returns and adjusting spending based on that. Whereas the line on the top with the green squares in it, what it represents is the same situation, but what the client is doing here is when the markets have certain returns, they take out certain amounts, and when they have other returns, they take out different amounts. So they're basically changing the amount that they pull out. So they're reducing spending when market returns are lower, and they're increasing spending when market returns are higher. And what you'll see here is that in this example, they're able to basically increase how long they have portfolio assets by about 5 years by just making those small adjustments along the way. And as Dennis often says, this is not going from filet to hot dogs. It might be going from filet to sirloin.
Well, yeah, hopefully not hot dogs or spam. But one of the questions that often comes up on this particular chart is, wait a minute, what's the significance of 1966 through 1995 in that time frame? Well, this is almost a perfect storm for a retiree. And we've also run some of these in the past that we've shown in our chats from 1974 through the mid to late 90s. And the reason that we use that time frame and this time frame is that the stock market had been peaking. We hit the big shocks of the early 70s, oil shocks back in that day. So we had a struggling stock market, and then we had the worst of all situations coupled with hyperinflation. So expenses are going up, portfolio assets are struggling, and for a retiree in a withdrawal mode, that is truly the perfect storm. Now, again, time will tell whether we're going to have any of that kind of storming going on. We actually don't believe we will be in that same kind of perfect storm from either a return viewpoint or an inflation viewpoint. But our radar and sonar is up at one of the highest levels ever around both of those issues. And so what Tara was talking about here is, even if we get into some of those kinds of things, there are ways to mitigate the damage later on. So let's go to the next slide.
And
Tara,
on this slide,
explain this highly colorful multi-line chart.
Yes. So I'm going to start over here on the chart on the left that's titled the working couple. So this is back to our example where you envision this working couple in their 50s. And where we're going to start is with the gray line. So the gray line was their plan projection. So it's showing what's supposed to happen with their portfolio assets year by year, all the way from 55 to age 100. If we had those base case assumptions, so we had the 5% return for 5 years and then 7% thereafter. So this was our starting point. So to help us answer the question of do returns matter more or does spending matter more, we're going to start by looking at the blue line. What the blue line represents is everything stayed the same for this client, except for this year, they experienced a 10% decline in their investment returns. And so what you can see for the working couple, yes, it impacted their financial plan, but they had such a margin of safety in this example that while it had an impact, it was not going to derail their financial plan. So it has some impact, but it's not detrimental. What we see by the orange line in this couple, so this is the working couple, that if they were to spend just 10% more, and the reason we use 10% is a lot of times we've noticed as we go through the planning process, clients typically don't account for about 10% of their spending on average. And so if they spend 10% more, you can see that that has a much larger, almost twice the impact of having a down market in just the first year. So for the working couple, it's easy to see here that spending more had a much larger impact. What the yellow line represents, and this helps the chart that Dennis and I were explaining, this represents what if this client reduced their spending by 20% this year and 10% next year, would that help them get back to the gray line? And while it does help their projections, it doesn't quite get them all the way back to what we have projected if the market didn't decline. So it's helpful, but it's not the total solution.
Yeah, and one of the important pieces here is we've been having conversations with a lot of clients, some of whom say the pandemic has caused us to rethink what we're going to do about spending on travel and other things in the future, and that number may be lower. Then we've talked to some who say the pandemic has made us rethink our spending about the future, and that spending may be higher. We actually saw that coming out of the 08, 09 Great Recession, is that really rocked everybody down to their core. And a lot of people came out of that saying, oh, life's too short. I'm going to go take that bigger trip now, or I'm going to buy that sports car, or whatever they're going to do. And so, again, every situation seems to, one size fits one in here in terms of what people are actually thinking about ongoing expenses after the pandemic is over. And we also recognize, we've said it before, at least a half a dozen times in these live chats, pandemics are about emotion. They're not about logic. It's a different part of our brain that's getting lit up by a lot of the pandemic issues and the civil unrest, and everything going on is lighting up a different part of our brain. And so we also recognize that decisions that are being made now may not be decisions that are forever. And in a calmer, cooler, rational post-vaccine world 2 years from now, a lot of individuals and couples will possibly come up with a different strategy. And that's fine. I mean, again, as Tara started out talking about, this is all about directional. It's not about hitting a bullseye. It's about a directional, making sure that we're moving in the right direction.
Great reminders, Dennis. And now if you'll focus over on the right side of this chart, we're going to look at the retired couple. And we want to see, do they get the same answer to the spending and returns question? So we've made the same assumptions for this retired couple. So you'll see the gray line is again their base case. And again, you'll see the blue line here is what if their investments decline by 10% this year? What you see here is this does have a larger impact in this client situation. And the reason is we have a smaller time horizon, and also they're using their assets to cover their living expenses. You'll also notice the orange line, while it does have an impact, it and the return are very similar here. So there's not as much of a gap as there was in the working couple, and the returns had a larger impact all the way out until the client's mid-90s. So here again, both of these things matter. And again, we can see with the yellow line that if they are able to reduce their spending 20% this year and 10% next year, that yes, it does help bring it back up closer to the gray line.
And that little line that I just drew If you go back to that prior chart where we had the boxes and the extending things out using the guardrail concept later in life, again, we have clients who are perfectly fine with their net worth going down later in life. We have others that want it to be maintaining for a whole variety of reasons. And so there's ways that we can make that adjustment line that you see on the screen happen as well. So next slide. So another big question we get, and we've been talking about the fact that while this pandemic has a lot of challenges, just like 08, 09 did, there's a whole lot of dissimilar things. And one is that we don't have the big bargains in stocks. You know, back in 09, we would be researching companies from PepsiCo to Johnson & Johnson to you name it. And the expected returns over 3 to 5 years were 15, 17, 19, 22% median between the high scenario and low scenario with AA, AAA rated companies. That has happened literally once in 2 or 3 decades that you get those kinds of bargains on high quality merchandise. That is not the case today. We do see some segments, and we've talked about them in previous chats, particular sectors of the market that have those kinds of potential returns over the next 3 to 5 years and maybe even greater. But they come with a different level of risk, and the more conservative stuff is not exactly on sale. And of course, some of the technology things are actually now getting a bit stretched in their own valuations. So without the big bargains and with bond yields super low and apparently going to stay that way for a while, what returns may be normal going forward, and how are we thinking through our normal fire testing approaches? So let's go to the next slide. So Glenn, I'll let you get in on some of the positive and negative factors, and then what our scenarios are around returns coming out of the pandemic.
Yes, thanks, Dennis. You know, the earlier slide said normal, and normal is a very interesting and perhaps elusive term these days. But as we'll see, there are a lot of factors to consider. And when we think about investments, we typically think more about stocks and bonds. So we'll focus on that some. But also, you know, we're talking more and more about having to look at other things like alternative or specialty investments. And also, that's more of just an effort to try to help with the risk-reward construction and try to figure out how we can better enhance returns, but also look to reduce risk. And so I think before we get into the slide, I think just kind of thinking where we are, it has been a very strong environment for stocks and bonds. And I think your starting point matters in terms of valuation. And as we'll talk about here in a few minutes, you know, we are thinking that over the next 5 to 10 years, given that starting point, i.e., stock valuations been a little bit elevated. Now, granted, the earnings are murky when you look out the front windshield, but we do think that you know, that does give us a little pause and suggest maybe a little bit moderate approach on earnings expectations and stock returns. And then on the bond side, we know that rates are very, very low right now, and really your bond returns are more a byproduct now, we feel like, of your income. So as we look at this slide and kind of think through that, and maybe a little more of a reset or lowering of expectations, there are some positives. I mean, it isn't all negative for sure. And you look at this slide, you look at things like the U.S. economy has been relatively strong and a little bit more of a beacon in the past, you know, the past few years is for the globe to look at and say, you know, the U.S. economy is doing relatively well. And that's reflected not in our economy, but in our currency. And so that's the good news there. And then public companies just have a variety of tools. I mean, you think about what's going on today, interest rates are very low, and that needs to stay low to help continue this trend, but they have a lot of flexibility on financing, just their labor in terms of outsourcing, using remote work. Productivity has been very good, and technology, as we see this last bullet point, in terms of the techno-industrial revolution, there's just a lot of things going well to help companies continue to navigate this current environment, which we recognize is very uncertain. And now for the negative side. So when we look at more of the negative long-term factors, I mentioned interest rates a little earlier. You know, it's been a very, very deflationary and decline interest rate environment now for going on 35 plus years. And so that's been very powerful for financial investments. And so the concern is where do things go from here? You know, I don't think anybody's predicting interest rates are going to rise too rapidly given economic growth is still a little bit subpar based on historical averages. But we got to recognize that if bonds start rising, that's going to create headwinds for investments, particularly bonds. Right now, the U.S. Treasury rate, I think on the 10-year, is maybe about 80, 84, really not quite 1%, so like 0.84%. And, you know, historically, it's been up above 4%. And I think that just kind of gives you just what we're looking at on the bond side. Now, granted, the U.S. Treasury is a very conservative investment, lower yielding than some bonds, but you still are not going to get, in our estimation, a lot of income from the bond side of the ledger. And then you think about things about our debt profile. Obviously, it's been a massive response on the fiscal stimulus side to kind of help us navigate and create a bridge through this COVID-19 environment. But we have to think about the longer term implications of our fiscal health here in the US particularly, and what does that mean in terms of things that we need to be thinking about around the corner. Now, economic growth, and also just thinking about not only the economic growth, but just thinking about if interest rates can continue to at least stay low, those are very vital because that'll help us continue to navigate through this. And as we'll talk a little bit later, perhaps, one of the other things that's very powerful, it's being undersold a little bit, is the millennial generation. That's now our largest demographic cohort. And we're hoping that much like the baby boomers powered things back in the 70s, 80s, and 90s, maybe they will start powering things more with their spending, because we know consumer spending is the big driver of the economy. That's something that is encouraging as we move forward. Now, the other negative here is the corporate tax cut, we call it corporate tax cut. The 2017 Corporate Tax Act is probably more appropriate. And that was a very powerful boost and was more focused on corporate earnings and helping corporations move forward. And so we do need to think about, does that potentially unwind later this decade, and what does that bring? And then one of the most powerful forces that really aided the deflationary and decline interest rate environment is globalization and just the opening up and integration of our global economy. So as you look at this last point, the concern we've been seeing is with the economic uncertainty and social unrest, there's just been a lot of kind of hunkering down and protecting your home turf. And so I think that is something we're monitoring, and that is a concern because it could start bringing inflation back to bear at some point. We don't know when, but if everybody's kind of focusing on their own, not looking for the lowest cost producer globally, there are ramifications there from both technological and a deflationary structure.
Yeah, and I think it's interesting, again, some of our viewers may remember a couple of years ago, we had a guest expert on who talked about blue jeans, and that if all the blue jeans were sourced back in the United States, how much more they would cost. And so they asked people the question, would you rather buy blue jeans in the United States or buy them from overseas? And a very large percentage said, rather buy them made in the United States. And then they said, well, if you would pay this amount more, does your answer change? And it almost flipped on its ear. I mean, a lot of people said, oh, okay, I didn't know it would be that much more expensive. And so that's the issue that's going on right now. In fact, a number of the companies we talk to who are looking at reshoring things and have already started doing some of that to the United States, but they're struggling with some of the cost issues. And it's the reason why a couple of weeks ago, we reported out in our written chat, 70% of CEOs of Fortune 500 companies are at least right now maintaining operations in a major way in China. So this deglobalization piece, we're keeping our eye on it because there's just a lot of forces going on here beyond economic, political, and otherwise.
Yes.
Okay, next slide.
So here, I think I'll take this one, even though it's a little more a financial planning topic, but we've been really, and it kind of gets back to the second question and that two-part question earlier about how we're kind of fire testing things and trying to consider different scenarios. And I think maybe Churchill, I believe, said this, but And I want Tara to get upset with me, but plans are of little importance, but planning, Tara, is very essential, right? And so I think that what that means is basically you kind of go into something with a plan, but you have to adapt and you have to react and you have to kind of obviously just figure out options. And so planning is very, very important. And I think when we look at these different scenarios in terms of how the economy may recover, there's a variety of them. And I think the first one is the V-shaped recovery, which just means that things snap back pretty quickly, somewhat like we've seen with the financial markets, the stock market, for example. We really, once again, the near-term future is very uncertain, but this V-shaped recovery would be obviously great if it happened. And so in this scenario, when we think about planning projections and helping clients get to their ultimate destination, we really are just saying, hey, things are going to be flat in 2020 from a growth or financial investment standpoint. But then next year, 2021 and beyond, we kind of get back to that 7% per year growth projections to kind of help you think about, where you're going to be over the coming years as you get closer to retirement or whatever your goals are. But that's the good scenario. And then we shift to the use scenario, which has been more the one we've been focused on as a more likely one, perhaps. And that one just takes a while to get back. You're talking about multiple quarters, probably 2021, before things start normalizing. And here, even though we've seen kind of our moderate and growth focusing portfolios come back quite nicely year to date in terms of returns, here we're saying 2020, expect a 10% haircut, and that will be down 10% for the year. Maybe that's a kind of, prepare for the worst, hope for the best, but at least it kind of gets people kind of face, what does that look like if things are that bad? And kind of really kind of lets people kind of say, what would I do if things turned out like that? And then we say, okay, well, let's think, maybe moderate just a bit. 2021, 26 will still be conservative and drop it from 7 to 5. And then beyond 2027, then we get back up to that 7% glide path. And so kind of back to what we might call normal. But then you have the L-shaped environment, which is a little bit concerning for sure. Here we stretch it out initially a little longer and we say, hey, it may take a couple of years and we may be down 10% through 2021. And it could really be 2 tough years back to back. And then all of a sudden, hey, things still need to kind of come back up in more of a modest fashion. So we look it out from 2022 to 2026 and say, let's go with a 5% recovery or glide path on growth. And then beyond that, we then get back up to that 7% hurdle or target. And once again, if you think about since 1950, about the last 7 years, I think stocks, at least the S&P representing stocks, US stocks, have returned about a little over 11% per year. And bonds have returned, I think, a little closer to 6%. We, once again, are saying, hey, it's probably best to kind of reset and just say, this past decade has been a really good decade to be an investor. And you probably start need to be preparing for things being more moderate. And, that could be shaving off some of the stock percentage and shaving off some of the bond percentage returns like we've done here. And once again, these are just projections. They're just something to help us kind of say, hey, this is more of a modest, kind of hopefully a realistic expectation. It could be better, but we at least want you to prepare for these types of an outcome.
Yeah, and one of the questions that came from our audience is assigning probabilities to these different scenarios. And so we still consider the U scenario to be the most likely scenario, the U scenario with whack-a-moles. And so again, a reminder on what are whack-a-moles? They are infections popping up. And we're actually seeing this right now. A number of states that have reopened are having their infection rates go up. And the good news, that sounds like bad news, but the good news is that there seem to be mostly small infections and not at a massive number. So that doesn't make anybody feel better if they're ground zero and they actually die. But from a whack-a-mole viewpoint, it's a smaller number of moles and they're smaller to begin with as moles. The U-shaped scenario that we're of course watching for is what if the moles are big? What if they're elephant size and there's 1 million of them? And, Florida has been identified as one of the ones that is being watched very closely as far as that infection rate, because they've had a lower incidence because they have less density of population. But there's a lot of concern that maybe the moles will be bigger and the wave will be bigger. So that U scenario could go a couple of different ways. Right now, our base case seems to be most likely, we would say probably 10%, 80%, 10%. So the V scenario, hate to be pessimistic, but we're just, and even beyond the whack-a-mole scenario, we have some great stuff, by the way, in our written chat coming out this weekend. We have an update on a survey of thousands of small businesses. And so beyond public companies even, there's just a lot of things that need to work out that are more in that U scenario than the V scenario. But there's going to be parts of the economy that will be the V. So when we say 10% for the V scenario, there's some parts of the economy that it's 80% or 100% probability they're going to be snapping back quickly. I mean, if we had the CEO of Zoom on right now, he'd say, yeah, we're at 140% or 200% of our snapback. And then the L scenario, that particular scenario seems to have largely been taken off the table by the federal and Federal Reserve and the federal government, both pushing a lot of money in to support things. And we just had a big announcement this week where they are changing some of the dynamics of the PPP program, extending it out. A number of our sources in banking and elsewhere said, yay, that is a huge piece to reduce the potential number of casualties. In our base case scenario, we still think there's going to be a lot of casualties. It could be 15 or 20% of small businesses that cease to exist. And so, and not dissimilar to 08, 09 in that respect. But so if you kind of think about 10%, 80%, 10% with the probabilities, back to the comment that Glenn made about plan and planning, which I seem to recall, Glenn, many years ago when you taught certified financial planning courses at our local university, that was a point that you made to all the students, is don't get caught up in the plan as much as you do the ongoing planning. And so I think that is exactly where we are today. We still have to be data-driven, watching what's going on closely. And if it seems like we're trending up or down on this, then change our strategy. Okay. So this is another one that we get the question a lot. If tax rates go up in 2021 due to a change in political leadership, what impact does that have on a financial plan compared to the current tax law is set to expire and go back to the 2012 higher tax rates in 2026 if Congress does not act proactively? So what if it happens sooner? Tara, next slide.
So Dennis, that's a great question. And I think to help frame this, we really want to look back and see, how did tax rates really change from the prior law to the current law? And so what you'll see at the top of the chart is, if we focus in on 3 sources of taxable income, you'll see that their effective, not their marginal rate, but the average rate that they're paying for somebody in these different taxable incomes would change by 3% if you were at 150,000, or 7%, and 6% at $500,000. But if we just look at the effective rate, it really doesn't tell the whole story of what happened with the tax law change. The tax law change, while the brackets changed and the marginal rates changed, and a lot of taxpayers focused in on those charts, what we have to really consider is how the deductions changed. And the deductions have a really big impact to what you report as your taxable income. And so if we really look at what's taxable income under the old law versus the current law, What research suggests is that a middle income taxpayer would pay about 1.6% less under the new law, whereas the highest income taxpayer would pay about 3.4% less. So if we were to go ahead and change back, if we were to sunset immediately, let's say we do that now, we would only experience a slight increase in taxes.
Yep, and so then the next extension of this question often is, if higher tax rates occur as a result of rising budget deficits, will that threaten my financial independence or create pressure on me to work longer? Next slide.
And Dennis, that's a great question. We have been hearing from a lot of policymakers and tax professionals and been asking what they think about this and what that might look like. And what they're suggesting again here is that while the marginal rates may go up more than the effective rates, we really want to focus in on the effective rates, because the effective rate is really what you're paying, while the marginal rate is what you're paying on the last dollar. And so here on this chart, I won't get into all the numbers, but we can see the effective rates only go up 3% for the $150,000 of taxable income, or even up to just 6% at the $500,000 of taxable income. Whereas the marginal rate on that highest tax income earner in this example is going up 15%. And so I think a lot of people get focused on that marginal rate, where we want them to be focused on their effective rate.
Yeah, and
So,
I think,
go ahead.
go ahead.
So on the next slide, what we'll see is we go back to our two couples. And what we did is we said, what if tax rates go up by 3% forever? So starting immediately, they go up for 3%. And then our plans already incorporate the tax rates going up to sunset rates in 2026, but we've increased it 3% above the sunset. And what you'll see here, again, for both of these examples, the gray is the base case, and the blue is what happens if those tax rates go up. And you'll see, while it does impact what they're projected to have at the end of their life, it's not a large impact. And so if we were to lay on top of this graph, the graphs we did earlier, this is a much smaller impact than the impact of their changing their spending or the market returns. The one final thing that I'll highlight on the working couple is we also ran a scenario, what if they work 1 year longer? And what this represents in this particular example is working 1 year longer, the percent that it goes up above where their base projection was is greater than the percent it went down by paying the tax. So what that implies is that they wouldn't even have to work 1 full year longer to make up for the tax differential.
Yeah, so again, I think an important thing to point out here is that both of these couples, but the working couple, we're talking about $300,000 of income. And so at least in the working years, are more subject to those rates we saw on the previous slides. And that's where you get to the effective rate going up by 3 and 3. So 3% by reverting to the 2012 Tax Act, and an additional 3% if you assume we need more money to pay off budget deficits, for 6% total. If we were running these on, some of our clients are making $500,000 a year and some substantially more than that, that's all going to be bigger impacts, because again, it is very likely that the future tax rate increases are going to affect higher income folks more than the middle income folks. And the other question that came out that from the prior discussion was, what about a W scenario? So we talked about a V, a U, and a L. What about the W? Well, the W is actually a version of our U. So if you think about a U with whack-a-moles the size of elephants, and there's millions of them, that's a W. That's a big set of additional infections that looks more like a W. We're just kind of folding it into our it's a really bad U scenario is the best way to describe that. Okay, let's go on to the next slide. So another question that we get frequently is if the pandemic does turn out to last longer than expected, and there's all kinds of definitions of longer, what is, back to comments that were made earlier about what is normal in this environment, what does that scenario do to my long-term financial independence? Next slide. Tara.
So Dennis, what we did here is we're back to our two couples. And we use our L scenario. So earlier you mentioned we don't think it's as likely, but it still has a chance. So our L scenario is where investments are down 10% this year and next year. And so what you can see is, yes, that does have a larger impact than if they're just down 1 year. But what you can see for the working couple is that they still have a margin of safety, even if we were to experience an L scenario. For the retired couple, the L scenario is represented in that blue line, and you can see that they're projected to deplete assets just right at the end of life. So what we did is what we do in a lot of our financial plans. We're fire testing your plan. What would make your plan not work? And so we want to find out what those answers are. But then once we know, we want to layer on top, what are some positive things that you can do to make your plan work and have a margin of safety out there? So in this particular example, what we did is we assumed that the client reduces their spending by 20% for the first 7 years, while returns are less than the historical average of 7%. And you can see by the orange line that that does improve their projections. No, it doesn't get them all the way back to the base case, but it does get them to a place where they have a margin of safety. And while in this example we use spending, I'll just remind you, there are a lot of ways that we can improve financial plans. Sometimes it's working part-time in retirement. Sometimes it's downsizing a home later in life. It could be renting out a second home. There's all kinds of ways to get there. And that's why looking at your own financial plan is important, to make sure that your goals are being achieved and what you feel is not as critical to have to enjoy life. Those are the things we want to make adjustments to get you back to that margin of safety.
Yeah, very important points. And so one reminder when you're looking at the left chart versus the right chart that is extremely important is that for most of our clients who are in more of a retirement mode, they're more conservative than when they were in their working years. And so a 10% down for 2 years, that is a huge decline in the stock market. I mean, that's, potentially going down 35, 45% from here over the next couple of years. So, that is fairly significant. And it just is a fact that we have diversification in bonds and other things that are in more conservative retired couples portfolio to cushion downside. And even in the working couple, we have a fair amount of defense on the field right now. So 10% down might translate into 15 or 20% down for the S&P 500. So, I don't know that I would call this the worst case scenario. That might be measured in less than 10% increments. But again, that's one of those where if we see things trending towards a worse or worser case, then we've got to be thinking about all those things Tara talked about, and we've got to be thinking about a lot of things on the investment front. So the integration of planning and investing is a very powerful combination. Okay, next slide. All right, so closing comments, Tara and Glenn.
I think that it's just a good reminder of we need to keep a pulse on your plan. While we always encourage clients about every 5 years or if something major happens in their life to reevaluate, but we can always help walk you through those. We've done so many financial plans that sometimes just having those discussions, we can help you evaluate whether something you're experiencing is a time where you should actually go back through the planning process, or if it's time where we should just kind of wait and see what happens before we do those reforecasts.
Yep.
Now, I would just add, I probably like a broken record, just to continue to think it's important to really hone in on that appropriate strategy and just reconfirm you are in the right investment strategy. I think typically you want to focus more on the probabilities and things, kind of lean into things that happen over the longer haul in terms of stocks are usually a good place to be, and in financial investments, growth. But at the same time, you want to be aware of those possibilities that could happen over short time periods, and make sure you've got insurance or hedging in place, and just make sure you're comfortable both from a fundamental perspective, but also psychologically to get through that.
Yeah, so we have a question from our audience about, there was a mention of alternatives early on in this discussion, and then a few times sprinkled in. Are they more or less important coming out of COVID?
You know, I think alternatives are going to be a pretty sustainable portion of the portfolio. There's going to be times where you want more of them versus less. I think right now the appealing thing about some alternatives, whether you're talking about real assets, for example, something that's more tangible, you can touch, feel it. I just think there's a good place, especially with the whole global growth and the need for resources that we're seeing with our growing populations. I think they just give you a different risk return dynamic. And so it gets back to diversification 101, having something in there that hopefully kind of zigs when the rest of the portfolio zags and gives you an overall better experience. So I think we'll continue to use them. It's just a matter of how much.
Okay, very good. So thank you, Tara. Thank you, Glenn. And again, some of this material will be in the frequently asked questions part of our written chat that you'll be getting this weekend. And this afternoon, we have our 4 o'clock Eastern time, interesting people with interesting stories and interesting times. We have a really interesting guest expert who was nominated by the Secretary of Commerce to be on the Malcolm Baldrige Quality Award, and just tremendous background in a lot of different areas about helping companies with change and transition on the future of work. And that is a huge topic for a lot of the companies that we work with. So we invite you to join us. As usual, these are all taped and will be available on our SFG YouTube channel. Thank you all, and hope you have a wonderful weekend.